hedge funds actually had their best month yet this year. In September, they returned an average of 3.6%, according to Barclay Hedge. This was just the 5th month this year that funds did have a positive return. And our next guest says hedge funds are going through a series of changes right now. I mean, who isn't, right? When you look at the mutual fund industry and markets overall. Donald Steinbrugge is chairman of Agecroft Partners. He was also a founding member of Andor Capital, which was the second biggest hedge fund firm, as ranked by Absolute Returns magazine. Thanks for coming in today.
It's my pleasure, Margaret.
So we look at a day like today, you look at the market activity with all the surprise, and you say the risk trades off this morning. Similarly, it sounds like that's what you're saying is happening in some ways in the perception of what is safe as a bet with managers these days in the hedge fund space. Hedge funds may be back, but bigger sounds better to the everyday investor.
Yeah, there's a lot of concern with the average hedge fund because 99.5% of assets are flowing to hedge funds with $5 billion or more in assets. So 99.5% of hedge funds are having a very difficult time raising money, even though they may have strong track records, strong investment teams, good processes. And I think that phenomenon is temporary, and I think you're going to see a major change over the next 2 years.
So what's driving that? Is the perception that there is safety in the bigger established names with more assets under management?
You know, I think there's two things that are driving it. The first is you have to break down hedge fund investors into their component parts. And there's a lot of dynamics that are happening with pension funds, fund of funds, and the 9 other components that make up hedge fund investors. And I can talk about that if you want. The second is after 2008, a lot of the hedge funds that were closed opened up for new money. And some of these did that in order to recapture assets that left, and others did it to generate new fees to pay their people. And I think what you're going to see over the next 6 to 18 months is a bunch of these close, although I also think that there's some that are going to morph into more kind of asset gatherers and probably take on a lot more assets than they should, which will result in them having diluted performance.
Well, then you hear from someone like Stan Druckenmiller, who just announced his retirement, who cited almost the cumbersome sense of a very large fund in terms of being able to generate consistent returns on the scale he had in years past. Does size matter in terms of reducing the amount that you as an investor can make?
There's been some studies that have broken down the hedge fund marketplace into different sizes. And for 12 years in a row, from 1996 through 2007, small hedge funds outperform large hedge funds. And I think that phenomenon is going to continue because it's much more difficult to generate alpha with a very large asset base.
You can just be more agile that way. Talk to me, you mentioned briefly institutional investors out there, the pension funds and the others. What are you seeing happen on that front? I would imagine that there's much more sensitivity on the part of those allocating capital these days because of what happened with Madoff and because of what happened in the markets back in 2008.
Well, there's two major trends happening with pension funds. The first is how much they allocate to hedge funds, and the second is how they capture that asset allocation. The evolution as far as capturing asset allocation starts with fund of funds, and then when they begin to go direct, they hire the largest brand names. And once they feel very comfortable with hedge funds, they then focus on generating alpha. This is exactly what they did with long-only managers. In the 70s, the major managers of pension fund money were Travelers, Metropolitan, Aetna, which manage almost none of the pension fund money today. They started with brand names, then they focused on people that generated alpha. A lot of these pension funds are very new to investing in hedge funds. Once they get comfortable, they will start hiring the mid and small size managers.
But they're not right now.
They are not right now. But it is the same trend that you saw with endowments and foundations. A lot of these endowments and foundations have a 50% allocation to hedge funds. They started with brand. Now a lot of them focus on the mid and small managers. The problem with them is they don't have a lot of capital because of all the capital calls they've had for private equity.
Well, you talk to hedge fund managers and they often say those kind of investors, they want the strategy that worked last year, but they want it now. What's the strategy of the moment here that's sort of most popular? Is it a macro kind of bet?
There's a lot of demand with macro, a lot of demand with CTAs because they're uncorrelated with long-only benchmarks, and a lot of these pension funds are trying to diversify their portfolio. A lot of money's been going into credit. I think a lot of the juice in the credit markets is already been captured as spreads narrow, although there are some niche parts of the fixed income marketplace where I think you can generate some pretty strong returns.
All right. Don, thanks for giving us the snapshot. I appreciate it.
It's my pleasure.